All right. We're on to our next session, and it's promised to be a very exciting session. It's going to be Dr. Roelof Botha. He's a local economist, and I had the privilege of listening to one of his talks recently, and you don't often come across a positive economist because it's easy to just sell the doom and gloom. And when we put together this event and we finalized the theme, I phoned him and he was quite happy to come on board. Now, we are privileged to also then have the Optimum Investment Group that is working very close with Dr. Botha. And the Chief Investment Officer is Roelof Botha from the Optimum Investment Group. And he's been in part of this industry now since 2010. And we've arranged that since they are working so closely together, that Francois knows Dr. Roelof Botha a bit better, and he's going to do the introduction and maybe also just quickly tell about their Optimum Investment Group. So Francois, over to you.
Thank you, Jasper. Thanks for that introduction. Good morning, everyone. Yeah, it's good to be part of the session. Really appreciate the time that we have on this webinar. Yeah, I think before I introduce Dr. Roelof, if I can perhaps just share my screen and just show you some bits of what's going on in the market and things that keep us awake, and just give you some background on where we are in the current market. I'm just trying to quickly put up my slides. Not going to take too much of your time. Obviously, Dr. Roelof is a speaker that everyone would like to listen to. But I think it would be good just to give a decent background on the markets, and then Dr. Roelof will obviously take us through the economic environment. Just before I kick off, can everyone hear me and see my
Yes.
screen at this stage? Right. I'm going to jump into it. As I said, just quickly going over the market, where we are year to date, what happens in the market. My second point is the year of extremes, and there were some quite interesting things going on in the financial markets, and I think the topic that I want to highlight is, if you manage funds and if you look after clients' money, is how you react in these extreme times. I think that is important when you manage money, is to make sure you understand what's going on, and then also to react in your portfolio and to manage the client's money in a way that they can obviously get better returns. And then I'll finally just quickly end off with the funds we have on offer and just the performance where we are currently in the funds. So just a quick overview of Optimum, the financial services group. See it as a one-stop shop for all your financial needs. We take care of short-term insurance. We do have health insurance, your medical aids, etc. Life insurance. We've got a legal team, payroll we can run for your business. We've got people doing labor, specialists in the labor market. Finance, obviously, we can take care of finance of assets that you can finance through Optimum. We do employee benefits, and then the last one where I fit is in the investment team, where we obviously look after pension funds money, individual clients' money, and the general public, the retail money. We've got several funds that we manage on varying on different risk and different approaches that we follow. And we've got a team of 10 specialists that helps me with that. And then obviously Dr. Roelof Botha is the economist that provide us with info on the economy, and then to translate that info into managing money and managing funds is obviously the thing that keeps us busy quite a bit. Excuse me. Just on the market, so the data here, sorry, it's not 2002, it's 2020. So just for the last year, the local market at the end of August is up 3.85%. Your listed property is still down 44%. And you can think about listed property as your office space, your retail space. I mean, no one really goes to a shopping mall, or I haven't gone to a shopping mall during the year. Office space is definitely transforming with the whole COVID crisis, and that has transpired in the share prices being down 44%. Your all bond index is 4% up for the year. I think our domestic bonds or government bonds is still offering the best real return above inflation in the world. We still see that as a decent opportunity to invest money in our bonds because of that real return you get above inflation. But then on the bottom half of the slide, you can just see the difference in the different sectors as well. If you focus on the resources sector, for the year, it's up 30%. Gold mining, platinum mining, your resource sector delivering amazing returns for the year so far. It's a combination of the commodity prices being at the all-time high, and then obviously also the weak rand help the performance of these companies. So they up 30%, and then your financials, your banks, etc., they down 30%. And then followed by industrials, which is up 5% for the year. So yes, it's been an interesting year, that in a sense that yes, the market has dropped quite a bit in Feb, March, and you've seen the decent recovery. But it's very specific recoveries that you've seen. Financials still being down 30%. Industrials not really shooting the lights out. So to manage portfolios, it was one of these years that you have to make sure that you're in the correct sector to actually get returns for your clients. On the global side, these returns all in dollar terms. On a year basis, everything is positive. It's as if the crisis or the COVID didn't really transpire in global markets. And I'm going to touch just on why that is the case. So I call it a year of extremes. If you look at the S&P 500, the left hand on the left there, you see all the bear markets we've seen in the past. And a bear market is defined as you lose more than 20% of your capital. It's the quickest bear market that we've ever seen from all the other crises, going back to the 1950s. It took 15 days to wipe out more than 20% of all the capital on the S&P 500. And on the right-hand side, just to illustrate to you, compared to all the other crises, some of it that you may know quite well, the COVID one was definitely a once in a lifetime experience where you lose 20% of your capital literally in 15 days. It's not just the US market, it's the South African market as well. What we've done here is just to show you the daily returns, the daily biggest negative returns. And I've obviously put a date on those days. And you can see the three red bars. So 3 out of the top 10 daily negative returns, the worst daily negative returns, occurred in this year. So you had a -6%, -8%, -10, call it 10%, 9.72% daily negative return. So it's in this extreme environments where you must make sure that you've got a process that you manage your funds with, that you stick to your process, and make sure that you don't overreact or get caught up in all the noise when days like this occur. What we've done is we've looked back on all the daily negative returns, that is in blue, that we've experienced in the last couple of years. So the biggest daily negative returns. And since that day, we fast forward and say, okay, but what is the subsequent 12-month return and the 5-year return? Remember, in the investment world, it's not about today's return and tomorrow's return. You invest for the future, and specifically for long term, for 5 years plus. And you can see in most of the cases when we receive this quite decent negative return of a -7% or -6, -5% daily return, your subsequent 12-month return is normally quite decent. And 5 years out, you in all the occurrences, you've recovered all your losses. So it's taking a step back, ignore the noise that's going on, and focus on what's the real value. Is it a decent time to increase your equity exposure in the funds? And if you've done that in the past, what would have been your 5-year subsequent return? And that is definitely the thing that we also did during March. We saw some extreme shares that came off extremely from their value. We did increase our equity weighting. We've seen a recent decent bounce back, and obviously that has benefited the clients. It's not just the bear market that was the extreme, it's also the recovery. I've showed you previously it took 15 days to wipe out 20% of your capital, but it also just took 33 days to recover. So this decent V shape that we've seen in the market. Obviously on the economy as well, Dr. Roelof will spend more time on that. But in markets, there was a extreme sell-off, but then also an extreme bounce. I think the main reason for this bounce is, if you ask me why did it recover so quickly, is all the central banks came to the party. What is shown here is the comparison between what was done in 2008 with the global financial crisis, the amount of stimulus that was pumped into the economy, that's the dark green circle, as a percentage of GDP, compared to what the central banks has done in 2020 with the COVID crisis. And you can see countries like Germany, 33% of the GDP, the size of the stimulus package is 33% of the GDP. Remember in South Africa, our president announced that 500 billion rand stimulus package that we would try to help the economy. And that was done all over the world. In the United States, in 2008, it was 4.9% of GDP. This time around 12.1%. And the slide is actually slightly outdated. Since then, they announced more and more stimulus packages. And that obviously kickstarted not so much the economy at this stage. There's definitely signs of recovery, but markets are forward looking, and markets look through the negative economic news and looking what's going to happen in a year's time, 2 years' time, 3 years' time, if you receive such a massive stimulus package. And that's why the market saw that massive recovery. Within the recovery, it was also difficult not just to go and say, okay, but everything recovered. It was definitely pockets that recovered. As I showed you earlier, it was the resources sector in South Africa. This is just an example that's just astonishing for me is, if you take the Apple share price, the market cap of Apple currently is bigger than the FTSE 100. Now, FTSE 100, as you know, is the UK stock market. So one share is bigger than the total UK stock market. It's bigger than the Russell 2000 index, just one share. So we've seen that this magnificent growth in Apple, but the same goes for all the other tech companies. So the recovery, yes, the market's recovered, but it's just a few stocks that led the recovery. But if you look deeper into the different economies and different markets, as you said, you'll see that there's still a lot of companies that's still in the bear market. And this speaks to the opportunity that's still available for investors. South Africa, 84% of our market is still in the bear market. So the resources companies, gold, platinum, Naspers, which is obviously technology, those companies recovered all their losses. They're flying again. But there's still 84% of our market that's still in the bear market. Your banks is still down 30, 40%. Decent opportunities in that sector. And it's not just the case in South Africa. In the US, 60% of their market is still in a bear market. It's your Facebook, Apple, Amazon, Netflix, Google, it's those companies that led the recovery. but the rest of the market is still in bear market territory. So I think there's still decent opportunities. You just need a portfolio manager that will be able to access these opportunities, and to make the right calls when the time comes to do so. In our market, this just to show you the top 10 constituents of the all share. For the last 3 years, they up, call it 50%. I've put in the little labels there. I think most of you know the companies. But if you strip out this top 10 constituents and you look at the other companies on our JSE index is still down 30%. So there's still decent recovery that one can receive by going into the call it the companies outside of the top 10. Yes, you must be aware of the risk. I've spoken about banks. There's definitely headwinds for banks locally. But the question is it already priced into is the headwinds already priced into the share price? And we think a lot of the bad news is already priced in. So there's a decent opportunity to invest in these companies. Just quickly on bonds, I think this is also something we took advantage of, increasing our bond exposure quite a bit in our funds. And this is the yield curve. So the dotted line just shows you the yield that you can receive, and on the x-axis the years to maturity. So obviously in a normal world, is the longer you lend money to the government, the higher return you receive, because your money is lent out for 10, 15, etc. years. And a year ago, the bond market or the yield curve was quite flat. Now I've highlighted or put in a red line here, the 0 to 2 year space, and that's where most pension funds or most income funds sits. They can't go longer than 2 year duration. So your income fund is limited to a 2 year duration. But a year ago, that wasn't a problem. For your pensioners investing in an income fund, you can easily receive a 7.5% return. But since then, obviously with rate cuts that we've seen, this yield curve has steepened quite a bit, meaning the front end of the curve moved down quite a bit. And now your income fund is only yielding call it 3.8%, from where it was almost 7.5%. You can see the opportunity in your income space definitely decreased quite a bit. So on the bond side also there's opportunities, but you'll have to go longer duration to get that same returns that what you received previously. We still think bonds is decent value. If you compare it to inflation, you get a real return in bonds that I think is still one of the highest real returns in the world. And I think once the dust has settled, the foreigners will also come back into our market. I mean, you can buy your US Treasury, your US 10-year bond, and you're going to get 50 basis points or 0.5% by holding a US Treasury. Or you can buy our government bond and you get 10%. Hedge out the currency, and then you still get a decent return. So there's quite a few things that in 2020 you had to be aware of. One thing that I want to just touch on before I quickly look at performance and then hand over to Dr. Roelof is just in November we have the US election. I think volatility will again pick up before the election. It's always the case before the US election. It's Biden versus Trump. The question I always get asked is who will be the best for markets? It's a difficult one because Biden will, I think, be better for global equities, equities outside of the US, because he will definitely the relationship between US and the Chinese will be managed in a better way. He'll probably go back to the Paris Climate Agreement again. So global relationships will be better under Biden. Corporates in the US will definitely be better off with a Trump victory, because Biden will increase taxes. He'll definitely increase corporate taxes. He's more socialist, whereas Trump is more capitalist, and Trump gave us that tax deductions or tax decreases when he came into the office. So I think it's going to be an interesting one. Biden, good for global equities, not so good for US equities. Trump, obviously, still good. He's a capitalist, will definitely be still good for US market, not so much for the rest, because I think yeah, the way he handles conflict and the relationship between China will still then be with us for the next couple of years. Just on performance, our funds, we've got a couple of funds to make it easy for you to reference. I've put the funds into the different universes in South Africa. All funds consist of different universes, and I've highlighted where we are in the first quartile. That's the light green blocks. First quartile, top 25% of all funds in South Africa. Our stable fund is in there. Our worldwide flexible fund is doing quite well. And I think in this market environment, to have all your funds in the second or third quartile, with all the volatility we've experienced, I think we've done really well. I'm gonna leave it there and then hand over to Doc Roelof. But if you've got any questions on Optimum, on the way we look at financial markets, more than welcome to answer that. Then it's my privilege to hand over to my colleague, Dr. Roelof Botha, who's completed his honors and master's degrees in economics via evening classes, and he managed to cum laude both of those at the University of Pretoria. He's done his doctorate in the University of Johannesburg. He shared platforms with 2 Nobel Prize winners and is the previous winner of the Finmedia Economist of the Year award. His professional experience is spanning over more than 40 years. It includes the following: economic policy advisor to National Treasury, financial editor of a daily newspaper, senior lecturer in economics at various universities, and chief economist of the SA Federated Chamber of Industries. He's worked with more than 500 different organizations, that's companies, employer organizations, public sectors, etc. More than 500 of these organizations make use of his experience. He's currently the economic advisor to the Optimum Investment Group. He's author of 5 different columns in the national and regional publications, including The Bright Side, published by Currencies Direct and Media 24. Recent accurate predictions include the decline in bond yields, which I also spoke about. He helped us with that. The recovery of the Rand exchange rate, he also predicted that correctly in 2002 and 2016. And then probably the best one of all is he predicted that the Springboks will win the World Cup. He's participated in various sports, including soccer, cricket, parachuting, and he's a member of the Gideons. Dr. Roelof, it's always good to listen to you, and just thanks again for all the knowledge that we can get from you.
Thank you, Francois. Right, I have a fairly pleasant task this morning, and that's to put the cynics in their place. I must just tell you that when I left the full-time employ of Rand Afrikaans University, which is UJ now, to join Gibbs, I was the first lecturer to be appointed by Nick Benedel, where I've been teaching part-time for the last 20 years. But essentially, I'm self-employed. I was forced through the legislation that existed at the time to put my pension in some investment. And I recently switched that to Optimum. And they did a back testing model. If I'd done that 5 years earlier, I would have had R500,000 Rand more in my pocket, and I would have not had to extend my career. I've been asked once, what will you do if you win the lotto? So my standard answer is, number one, I'll buy myself a Ford Mustang V8. I'll put a bit of money aside for a good divorce lawyer. And the rest of it I'll give to Francois, because he's taking very good care of my pension, and thank you for that. Right, V-shaped economic recovery on track, without a shadow of doubt. I think you spotted some of that in Francois' presentation as well. Now, what we're dealing with here for the next 20 minutes or 25 minutes is absolutely fact. Everybody's entitled to their own opinion, but not to their own facts. And let's have a quick look at the facts on offer. The viewers are all obviously well informed, and what I'd like you to spot from these slides is the balanced perspective. Be very wary of media reports that quote sources who cannot be verified in terms of their qualifications or their experience to actually conduct macroeconomic long-term forecasts. I was very disturbed to recently read in one of these publications that 4 individuals who apparently get together from time to time, and they've established a website, have predicted that South Africa will become a failed state by 2030. That is absolute nonsense. I can guarantee you that. If you want authoritative research on this issue, you are welcome to contact the University of Stellenbosch's Institute for Future Studies. Marius, I think it's Mostert, is in charge there. They recently commissioned a very detailed long-term perspective on South Africa, 4 different scenarios by those 2 brilliant German brothers, Becker, Marcus, and Joachim. And each one of these 4 scenarios, although they differ from each other, are extremely positive about this country's long-term future. We have a pivotal role to play in the development of sub-Saharan Africa, which is the last latent, huge latent consumer market. Just in SADC alone, we have 340 million people. That's 20 million more than the United States. Much smaller per capita income, I know, but growing at a faster rate. What we need to do, obviously, is to get cracking on incentives for capital formation. That includes infrastructure creation and to create an environment which is more deregulated and which creates more confidence amongst business people. And that is exactly what President Ramaphosa, Mr. Tito Mboweni, and his cabinet are busy doing. They were held back because of the virus, but we are going to move forward now. And this is a paradigm shift from the approach to economic policy that we had for the last 10 years. So much of the mess that we're in right now is related to the 10 so-called lost years. And I would really urge you to just try to think a little bit ahead in terms of what is possible. Just one other point, PwC, which has an extremely well-qualified and well-staffed economic research division, they have recently also conducted long-term forecast for key emerging market economies, and they expect the South African economy to grow from its current level of 800 billion US, that's in purchasing power parity terms, 800 billion US, to 1.1 trillion by 2030. That is not the sign of a failed state. A failed state does not attract foreign visitors. We had in 2019 10 million foreign visitors visiting this country, of which 2.6 million were from overseas. So please be very wary when you read stuff in the media that has been written or researched by people that actually don't know what they're talking about. Right. By the way, the definition of an economist, it is somebody who will marry Charlize Theron for her money, which is not a bad idea depending on the mood she's in. Right, I'm going to move fairly quickly through these slides because they're self-explanatory. And just to demonstrate the fact that I'm not naive, I'm aware of the problems that we have. We saw the bond yield initially heading for 13%, which remember that your bond yield is inversely correlated to the value of your bonds. So that move, when the pandemic really hit us in our bond yield, meant that the value of our bonds was declining at a rapid rate. And I want to make this a little bit, introduce a bit of fun. Now, I know that you're probably frowning now. How the hell can economics be fun? But I want you to count the V's. It's just a bit of a challenge. So this is actually the first one, but not what you see on the screen. You must use your imagination with some of these V's. So if you were to calculate the reciprocal, the value of our bonds, then you will see a pronounced V here. And that's the 300 basis points which I decline, which I forecast correctly. The cynics are still mad at me about that. And here's the rand exchange rate, which I also predicted correctly. Very easy one to call because this was an extraordinary event. And in fact, its value today is not far off from where it was when shortly after Mr. Nene was dismissed as Minister of Finance. And we had the unfortunate situation of having a new finance minister for a weekend only. It was a weekend special, and fortunately, it did not last more than one weekend. So bear that in mind. Now, once again, this is the value of a dollar, by the way. That figure that you see today, 16 rand something, that's the price of a dollar, not the price of a rand. So once again, you have to calculate the reciprocal, and there is another V. As far as the real effective exchange rate of the rand is concerned, the red line on the slide, I don't want to become too technical, but the red line, just try to remember, that's where the rand wants to be. That's where it's accurately valued. The blue line here is the value of the rand against a basket of our key trading partners' currencies. So when the blue line declines, it means the rand is depreciating and vice versa. And you will notice that it was on its way back to where it should be, the red line, after Mr. Ramaphosa's election, when the trade war hit us and then the coronavirus hit us. Point I want to make is 2 points. Number one, the rand is undervalued by about 25% in that vicinity. It's on its way back to the red line. On the way to the red line, it will remain volatile. Make no mistake about that. And that is why individuals really need expert advice when it comes to any form of currency trade. There may be some of you that will tell me, but whoa, our public debt is going through the roof. On this slide, pre-COVID, it was just below 60% of GDP. Now it's headed for 80%, Tito Mboweni tells us. Now, just remember that this is not a problem that is unique to South Africa. You can add between 10 and 20 percentage points to every one of these countries' public debt GDP ratios. And yes, moving to 80% is not pretty, but remember that Japan is heading for 300%, and the US has been above 100% for quite a while. France is over 100% as we speak. So the secret here is to just look at the maths. Public debt divided by GDP. So if you have a fairly good handle on your public debt, which we will have after the virus has passed, then your secret is to get the GDP growing, because if the denominator increases, the sum declines. And that is what Mr. Ramaphosa and Mr. Mboweni are going to do. And they've started doing that already. We are going to have spectacular growth in the next at least 4 to 5 years. I can comfortably predict that. Our debt servicing costs is not out of kilter with our trading partners. You can see on this slide. And just to also indicate that I've got my feet on the ground. I speak to business leaders in large, medium, and small companies almost on a daily basis, because those type of informal surveys are invaluable to an economist. And it is true that some sectors will take longer to recover, especially commercial aviation, hospitality industry, etc. But some of them have done exceptionally well. And Francois already touched on what happened to Apple. Now, just look what happened to Uber. I think we all know about Uber. Look what happened to their rides. I mean, a 75% reduction, but Uber Eats increased their revenue by more than 100%. That's double. And as we move forward, I cannot see Eats declining, terribly. So there's a new platform that's been established, but the rides will obviously start picking up again. And I think that's terribly important to realize, is that new opportunities have arisen as a result of the fourth industrial revolution having been thrust upon us by this pandemic. And of course, a lot of stuff happening in the digital space and the virtual space. And here you can see it with some of these other companies, from Facebook to Amazon. Their revenue growth would certainly have been more muted if it had not been for the virus. I just thought I'd say a quick thing about agriculture, because there is no substitute for food. And I think every South African realizes how important it is to have food security. Now, our country is in the fortunate position to have a vibrant, agriculture sector and an almost even more vibrant food processing sector thanks to agriculture. And we export a hell of a lot of food to the rest of the world, but mainly into sub-Saharan Africa. Now, the 100 billion agriculture value added, that's the average for the last couple of years. That translates into turnover through the whole supply chain of almost 2 trillion rand. If you damage this sector, you are playing with fire. You must protect the sector and not make statements to the detriment of the type of incentives that we need to create more stability in agriculture. It is fraught with risk. You've got the weather against you. You've got crime against you. You've got a lack of infrastructure in the rural areas against you, etc. And the agricultural sector in South Africa needs the full support, the unconditional support of this government, and that holds for every single member of the cabinet. You can see agriculture's superior productivity in the fact that the fixed capital stock, to their share of that to the total, is declining relative to their share to GDP, which means that they are producing more with the same fixed capital stock. Very well done. And the yields are just increasing. It doesn't matter which commodity or product you're talking about. Our oranges are doing unbelievably well. One of the reasons for that is also related to COVID. Can you believe it? Because of the vitamin C. There's a belief that this is a really good way to boost your immune system. And I think that we probably know that already. Now, the move from lockdown 2 to lockdown 1 is going to have a profound impact on our economy, positive, of course. So just to demonstrate that, I've had a quick look at the agri-tourism facilities just in the Western Cape, based on research by Wagner and his associates. So these are the number of establishments that cater for those type of facilities, from horse riding to fishing to cellar tours to accommodation. It's 8,500 roughly in total. Now, if you just work on an average conservative 2 million turnover per establishment, we are talking about a 17 billion rand demand injection coming into the economy that was not there during the lockdown period. So certainly things are moving rapidly back to more or less normal. I spot another V here. The AGBIS IDC Agricultural Confidence Index is above 5 at its highest level since the second quarter of 2018, which is fantastic news. I spot another V, that's the value added in agriculture. It's a 4-quarter moving average. Please note that, because it's very volatile. Of course, businesses, agriculture, farmers, we all have to deal with the bureaucracies. And I've been told that the reason why they changed the streets in Pretoria into one-way streets many years ago was to prevent the civil servants that arrive late in the morning and during the day that they don't obstruct the ones that want to leave early. That's just a rumor. And here you can see an amazing slide. For the first time in modern history, agriculture and food in a 7-month period has been the #1 generator of foreign exchange to this country, beating vehicles into second position and beating the big guns, platinum, gold, and iron ore, who have also come to the party big time. So well done to our farmers and to our food processors. And there you can see the growing agricultural trade surplus. And as I said earlier, the bulk of our exports of agriculture and food are going into sub-Saharan African countries. And we need closer collaboration with them, as far as I'm concerned. The economies are taking off again. I never thought I'd be pleased to see the oil price recover. But that means that the world economy is starting to grow. And obviously, I spot another V. I'm trying to make it easier for you to count them. And an intriguing slide where you're going to have to use your imagination for the counting V exercise. So I did not include February or March's PMI. That's the Purchasing Managers Index. It's a composite one, so it's services and manufacturing. Because if I'd done that, the slide would have become a little bit too busy, and I wanted to include the 6 largest economies in the world. You will notice that France is not on this list anymore because Brazil has overtaken them, and Brazil will overtake the UK probably within the next, I don't know, we're talking about months, not years here, just as a matter of interest. So if you were to include February or March's PMI, for all of these countries it was above 50, you will see a V for every single one of them. So there's another 6. China's was very pronounced and 2 months earlier. Bearing in mind, of course, with these one-dimensional slides that there is this definition of a statistician which goes as follows. A statistician will tell you if your feet are in the oven and your head is in the freezer, on average you are quite comfortable, but I wouldn't try that. So once again, a slide where you have to use your imagination, in the sense that if you were to imagine that the 2019 actual GDP growth figure were to have been figures were to have been included in this slide, you would notice a V for every single one of these 7 countries. Never in the history of the IMF has the forecasts for 1 year and the forecasts for the next year had exhibited such a large spread. And obviously it's because of this absolutely extraordinary event out of the blue. The good news is that we are recovering very fast. The South African perspective looks really good. And really, just to deepen that perspective, let's have a quick look at 2 industries that are so well known to us: long-term and short-term insurance. I'm not aware of anybody in my circle of influence that doesn't have either short-term or long-term insurance. And these are massive industries with assets, running into literally trillions of rand. And I think we must just take one step back and ask ourselves, what was it like? What was our economy's sort of growth thrust before COVID hit us? Were we on the way down or not? Well, not in terms of short-term insurance premiums received, and that won't happen unless people, if you look at the long-term trend, unless people are buying assets. Also not as far as long-term insurance premiums are received, and that will not happen unless there is formal sector employment creation. And just a quick word for the cynics, before you want to counter me with the unemployment rate. Our unemployment rate just before COVID had not changed materially in 40 years. We have created, since democracy, 1.5 million formal sector jobs alone, and probably, according to some estimates, 2 million informal sector jobs. So once again, our economy was on the way up as far as I'm concerned. I've got another slide on that will drive the point home. We have a cumulative trade balance this year, just this year, since January, of just short of 100 billion rand, which is an all-time record. We have balance of payment stability. And one of the reasons, if you're wondering, but how was it possible for the economy to recover so quickly? Well, one of the main reasons is that despite the strategic importance of agriculture, and to us mining as well, they are small contributors to value added. Their contribution happens later, as I demonstrated with the agriculture slide. And today, the services sectors in South Africa account for almost 70% of GDP. In the US, it's 80%. And this is one explanation. These sectors are more resilient, and obviously you can work from home. Now, I'm not naive. I know that real household disposable income, that's now disposable income adjusted for inflation, will decline this year. The decline may be in the vicinity of 4%. It's not going to be a train smash. It is for some individuals, unfortunately. But it will recover dramatically next year. And in nominal terms, it will hardly take a hit. Our current account of a balance of payments has a surplus for the first time in 17 years. And that is also related to a large extent to the fact that our ratio of foreign income receipts, this is the profits, the rent, the dividends that we receive, that South African individuals, pension funds, long-term insurers, places like Optimum, that they receive on their foreign investments on behalf of their clients as a ratio of income payments, which South Africa has to pay to people that have invested in South Africa. And that is very, very good news. And once again, a sign of fundamental stability. So back to the question of where were we in the first quarter of 2020, our economy? Were we in a recession, as that SA are suggesting? No. And I've told them that on a number of live TV programs when they erroneously told us a couple of weeks ago that our economy shrank by half in the second quarter. I mean, this is just so ridiculous. Our economy shrank by somewhere between 14 and 17%, depending on whether you are looking at year on year or quarter on quarter, and whether you are adjusting it for inflation, which is on its way to zero almost. So what I've done here, just for your benefit, is to take our GDP and adjust it to move to gross national product. And you do that by adding foreign income receipts and deducting foreign income payments. And then deflating that figure by the CPI and comparing it to the first quarter of 2019, which is the recommended method according to the OECD. And in the first quarter of this year, we had positive, I'm going to repeat that, positive real growth of our gross national product on a year-on-year basis of 3.6%. And we were heading for the type of foundation for growth that President Ramaphosa had envisaged. And then the virus hit us. So we were in a recession in the second quarter, I mean, obviously, but we are already out of that scenario. We will have positive quarter-on-quarter growth. ICVs, look at the mineral sales at current prices, magnificent recovery. And in fact, in the first 6 months of this year, our mineral sales almost exceeded the all-time record of 268 billion rand for January to June period recorded last year. This is really almost miraculous. Retail trade sales, I see another V. You will notice that in November and December, there are two spikes. There used to be one spike, but now with, I think it's called Black Friday. I'm not sure. It's a day when, there are all kinds of bargains in November. You have the first part of the spike in November and then the second one with the Christmas holidays, obviously. So if you isolate the general dealers, and this is a fascinating slide, and which the cynics really hate, and I'll never show it to you. So if you look at the general dealers, retail sales, which is about half of the total retail sales, in June this year, this is now June, remember the lockdown? 40.5 billion rand. That's what we spent in the shops at general dealers. Let's go to June 2019. 39.6. So it was higher in June 2020, in the middle of a lockdown, than it was a year earlier. So please don't tell me that we are not having a V-shaped recovery. Another one, wholesale trade sales, magnificent recovery. Another one, the JSE. Cynic once said, how do you make a small fortune on the JSE? You start with a big one. I find that very cynical, and that won't happen to you if you speak to Roelof Botha, I promise you. By the way, he's not a relation of mine. I wouldn't have minded, by the way. And he also teaches postgraduate at the University of Stellenbosch, part-time, by the way. So he knows his stuff around investments. And I'm just about finished. I'm coming to my the cherries on top of this economic cake that I'm baking. The prime overdraft rate is at its lowest level in 50 years. What's the big deal with the prime rate? Well, try to remember that it's highly likely that the prime rate will remain exactly where it is now for quite a while. And if the Reserve Bank has any sense, they will send a message out that lending rates will remain low for a considerable period of time, because this country does not have an inflation problem. We have a problem with insufficient demand, and we need to create jobs. I think everybody understands that, except until recently, the Monetary Policy Committee, but maybe they'll see the light. So what's the big deal? Lending rates, ladies and gentlemen, are inversely correlated with most durable and even semi-durable consumption products. I've used new vehicles as a proxy. And obviously also, if your lending rate is too high, it acts as a tax on venture capital, and that's what we need to see. Francois showed you an interesting slide right in the beginning, where he showed you that the small and mid-cap shares on the stock exchange are not doing very well. And one of the reasons for that, obviously, is the high interest rate. Another reason is the overregulation. Government must, and I think they have already realized that we must absolutely reform our labor legislation. We have to make it easier for employers to employ people. And quite frankly, I like to believe President Ramaphosa appreciates the fact that there is not a lot of risk, political risk involved by showing COSATU the door, because the ANC and COSATU does not have to be in an alliance. It's not cast in concrete. There's not even a document in this regard. If COSATU thinks they have a point, let them contest an election, as one of the trade unions did a couple of years ago. And somebody in that trade union actually bragged in public. He said, if every member of mine and their wives and one friend votes for him, for his party, it obviously had the word socialism and revolution in the theme, which is not what we need. We need common sense. But anyway, back to his bragging. He said he would have 7 seats in parliament. How many seats did he get? 0, which is very good news for South Africa. We need an economic environment conducive to job creation, and the current labor legislation does not do that. So back to interest rates and the power of interest rates. So Prof. Ilse Botha, there's many Bothas this morning, and she's also not a relation. She was from Rensburg 28 years ago, the best student I ever had at UJ. She's today an internationally acclaimed econometrician, and I assisted her to build a model where we asked the model, what would South Africa's GDP have been today if the real prime rate, now this is not difficult to understand, the real prime rate is simply the prime overdraft rate, which is currently 7%, by the way, minus the CPI, the inflation rate. And that figure was on average 3% when Jill Marcus was governor of the Reserve Bank until 2015, the best governor we ever had, by a long shot, except, of course, for Mr. Mboweni. I must always bear that in mind. Okay, so then she retired, and Mr. Zuma appointed a new monetary policy committee, and they took the real prime rate ultimately to more than 6%. So they increased the cost of capital by 100%. That is not very bright, and I'm trying to be very diplomatic here. So on average, it was 5.3% after our departure. The model told us that if the real prime rate had stayed at 3%, our GDP today would have been 560 billion rand. That is a pretty nifty figure. It's more than R500 billion, larger than it is. So my message to you, one of my key messages here is, do not underestimate the power of lower interest rates, which we've got. Let's enjoy it. And this is one of my jewels. ABSA, Bureau of Economic Research Purchasing Managers Index, the PMI for manufacturing, has gone to its highest level since 2007. And I spot 2 V's here actually, but I think technically this only counts as 1. This is really fantastic news, my last slide. And once again, if you use your imagination and you include 2019's actuals, and on a year-on-year basis, we did have marginally positive growth in 2019. That's a fact in real terms. You will spot a V for every one of these 7 predictions by some authoritative research organizations and financial institutions, including Optimum. And there are several economists that are predicting growth of more than 4% next year, including myself at the Optimum Investment Group. And there is absolutely no reason why we cannot build on that momentum. This economy grew for 5 years in a row at 5% per annum, which obviously helped me to win the Economist of the Year award because I'm the eternal optimist. We can do that again. I want to maybe just give you 1 or 2 parting shots. Try to remember that Venezuela and Zimbabwe did not become failed states because of a lack of resources, because they don't have enough labor, because they don't have enough, the market isn't appropriate, there's no infrastructure, etc. They became failed states for one reason only. They had governments that chose the wrong policies. Policies of nationalization or extreme socialism, whichever sort of definition you want to use, are designed to destroy an economy. In South Africa, we have got a president that is going to implement economic policies which are the linear opposite to what happened in Zimbabwe and Venezuela. Policies can make or break a country, and our policies are slowly but surely coming into place. And what's the beauty of this all is that it's going to be implemented with the full participation and cooperation of the private sector this time around. The 51 sustained infrastructure projects, which have already kicked off some of them, combined with low interest rates, I can almost guarantee you, are sufficient to take us to 4 to 5% growth for the next 4 to 5 years. And who knows what can happen after that. The sky is the limit. We have a tremendous future ahead of us in this country with all our cultural and economic diversity. We are the most economically diverse of any emerging market in the world. So I am so bullish about the future, especially now that we're at lockdown level 1. All the best to you. Thank you.
Oh, thanks, Roelof, really, and Francois. Thanks to both of you. Really appreciate all that information. Once again, a power-packed presentation with lots of information. And I totally lost count, Roelof, on the V's. I can only get to about 3 before I lose count completely. So, yeah, Trevor as well. So, yeah, you might have to tally those up and send us a note of how many V's you had there, because yeah, no idea. But yeah, unfortunately, we have run out of time on this particular session. So if I can ask Francois and Roelof, if you want to just stick around, please do. There are some questions in the chat box. Feel free